In today's video, you're going to learn everything that you need to know about the infinite banking concept. You're going to learn about what it is, how it works, what's the upside to it, what are the benefits of it, what are the potential pitfalls of it, and you're going to have all the information that you potentially need to make an informed decision to see if it's right for you. That's the goal of this video. Stick around to the end of the video, because at the end of the video, we're going to point you in some directions that you can get extra help if you need, contact information and things like that. Today is the day. All right, we get a lot of questions about IBC. What is IBC? The infinite banking concept. How owning cash value insurance policies can really set you up for success. I talk about recycling capital. This is one of the top ways, in my personal opinion. That way you can have money go to work for you and you can still have access to it while it works, which is a very, very unique concept. You can basically turn all of your expenses into income and you can make liabilities assets. Sounds crazy, I know. There's a reason I have Harper and Jim with me today. And the reason for that is because these are the guys that I trust with my policies. They built my policies, so I'm confident that they can work with you and do the ethical thing and work with you in a way that it can fit your life. So that's why I want to share this with you guys. Jim's going to go over a presentation, which is exactly how I started years ago. And you're going to start to see the benefits and what's possible within the infinite banking concept. So at this point, I want to give it to Jim. And at the end, after the presentation, I'm going to be able to ask them some questions. It's a lot of the common questions that I get. So we're going to be able to go through those. And I think it'll really help you guys. So Jim, the floor is yours, my man.
Awesome, Todd. Thank you. I really appreciate that. And always excited to share IBC with people, because especially people that are in real estate, because the two just go hand in hand. But I'm going to, because you mentioned something about assets and turning what's an asset and what's a liability, and how do we create a system that is to our advantage, not to somebody else's advantage, and where we're in control. Because I always like to say, whoever controls the money makes the money, right? So I want to just kind of do a little review, Todd, of banking, like what makes banking work. And by the way, banking is the most profitable business in the world. And there's a reason for that, right? Because they're controlling the money and the money flow. But I'm going to break it down into simple terms. Okay, so let's just look at how a bank works in its simplest form. First, you need a depositor, right? The bank needs somebody to deposit money in the bank because they don't use their own money. So you go down and you deposit money at the bank. By the way, when you deposit money at the bank, is that an asset or a liability? Now, I know, Todd, you already know the answer to this question, but when we ask that question to your audience, I promise you a large percentage are going to say it's an asset to the bank, but it's not. It's a liability, because the bank has to give you that money back anytime you want it, and they haven't made any money using your money yet, right? So how do they take that liability and turn it into an asset? Well, they loan that money to a borrower. Now, the bank knows that the borrower is going to pay the bank interest, and then the bank's going to pay you as little interest as you'll accept, right? And by the way, this is what they want you to see. This is above the surface. This is the scene. All right, but let's dig a little deeper and see if this really makes sense. So let's say you deposit $10,000 at the bank. And let's just say that the bank is going to earn 5.2% on that money, and they only have to pay you 0.2%. Okay? The percentages really don't matter. What they're going to do is they're going to get the most that they can get and pay you the least that you'll accept and not move your money, right? Okay, so that means if they're paying you 0.2%, you're going to make $20 over the next year, and they're going to make $520. Now, our consumer brains say, well, the bank's only making $500 more than me. No big deal. But Todd, you know that's not how a business works. The way a business works is I take my cost, I divide it into my profit, and here I see that goes in 26 times. $20 goes into $520 26 times, which means the bank is making 2,600% more than the depositor with the depositor's money. Okay, so let's look at the players in the play here. we have the the depositor, sorry, we have the owner, and we have the borrower. Those are the only three players in the play. Now, here's the funny thing, is there's only one banking system in the world. To say that they're not all interconnected would be like saying water in the Amazon is not connected to water in Lake Michigan. That's silly, right? Because water evaporates, goes into the atmosphere, it comes back down to earth in the form of rain, snow, sleet, hail. The banking system is the same. In fact, Todd, have you ever heard the term money follows the sun, where a bank closes, lends its money to a bank that hasn't closed and another bank that hasn't closed, and it just follows around the earth? And it's called, like, that's why there's overnight lending rates, and people go, I don't know what that means. So it's all interconnected. So what that really means, that if you have money deposited at one bank, you have money borrowed at that same bank or another bank, they're really making 26 times more than you with your money from you. Now, who would do that if they understood that was what was happening? No one. And what infinite banking is in a nutshell is we're going to build a wall around this. Now, if we build a wall around this, and we are all three of these players in the play, all three of these entities, how does anybody else make money off of us? They don't. How do we lose money? We don't. Okay, so that's how a bank works. Let's look at infinite banking and see how we can make infinite banking work. All right, so the first thing we start off with is an insurance policy. And the last thing that I want anyone to do is put money in an insurance policy, let it sit there and do nothing. Okay, I know there are companies out there that advocate for that, but that's not what I'm asking you to do. Okay, you're going to buy an insurance policy, and it's the way that a bank buys BOLI, bank-owned life insurance, or a corporation buys COLI, corporate-owned life insurance. Now, why would a bank or a corporation buy life insurance? For the cash, right? And I'm going to show you why. But we're not going to buy it like a consumer for death benefit or illness protection. By the way, it has that stuff, but we're going to focus on the cash. We're going to buy this policy from a mutual insurance company. Why a mutual insurance company? Well, there are only two types of insurance companies in the world. There are stock companies that are owned by shareholders, and there are mutual companies that are owned by the policyholders. We're going to be a policyholder, so we want to be an owner, because insurance companies are required by law to distribute the profits to the owner. We want to be an owner. Okay, so now we buy this policy from a mutual insurance company, and because we're an owner, we have a contractual right to take an interest-only loan. This is you, an interest-only loan. Okay, so Todd, you know what an interest-only loan is. Most of your audience does, but let's look at it the way that we should look at it. It's like this. Let's say I would loan you $100 million today, and your only obligation is 1 year from today, you have to pay me, let's say, $5 million of interest. 1 year from today, would you take the loan? And I know you would, because you know what to go do with the money. All right, so Todd, let's say that you made me that same offer, okay? And if you want to make me that offer, Todd, we can talk after the recording. So you're going to loan me $100 million. I'm going to take your $100 million. I'm going to go to the seller or the bank, and I'm going to borrow money to buy a portfolio. So I'm going to buy $500 million worth of real estate, because I know I can get at least 80% loan to value. So I'm going to get 80% loan to value. And then I'm going to call you in a year, and I'm going to say, hey, Todd, I've got your check for your interest. and I'm going to come up and I'd love to buy you dinner and give you your check. So I fly up, hand you your check, and you say, hey, Jim, do you want to pay any principal? And I say, nope, see you next year. Because I'm going to make on that 100 million, 25% cash on cash, at least. Okay. So I'm going to make at least 25% cash on cash. I'm going to make 25 million bucks. I got to pay you 5. I'll do that every year till I die. And if I want to pay you principal, which I wouldn't, in this scenario, if I pay any principal back to the insurance company, they have to let me borrow it again. The reason I wouldn't pay you principal or the bank principal is because you might not give me the money again, because you're in control, not me, of the money pool. In this scenario, I'm in control. So that interest only loan is really important. Okay, so guaranteed, they have to give me up to 100% of the money that I've deposited in my policy. They have to give it to me. No application, they don't ask me any questions, just where to send the money. Okay, now let's think about that for a second. I have this insurance policy, and what they do is up to 100% of my cash value. All they're gonna do is put a lien on my cash, and they have to give me their money, other people's money. So now I have other people's money. I have use and control of it. And I'm gonna go buy something. I'm gonna go buy cash flowing assets like real estate. Okay, so here's my assets that I'm going to buy. Now, to make this simple, I'm just going to simply call each project real estate 1, 2, 3, 4. All right, so I take the insurance company's money. I put it into real estate project number 1. It cash flows. Again, what's the difference between poor people and wealthy people? The direction that their money flows. Poor people, money flows away from them. Wealthy people, money flows to them. As soon as this money comes back, what am I going to do? I'm going to redeploy it, and I'm going to buy real estate project number 2. It's going to cash flow. It's going to come back to me. By the way, who else does this? Well, the bank does. Think about your mortgage. So what the bank's going to do is, I'm going to pay my mortgage payment. Todd, you're going to pay yours. Harper's going to pay his. And they're going to bunch all of that money together with a bunch of other people's mortgage payment, and they're going to loan it out again for another mortgage. So then they're going to earn interest from you, from me, and they're going to have all these generations. They're going to create velocity of money, turning the money each time you, in a business, every time you make a turn, you make money, right? If you're painting houses and you paint more houses, you make more money. The more you can do, the more money that you make. Same in banking. So I just keep doing this over and over again. And I'm only going to do this 4 times. Why 4 times? There's no reason. And what do I end up with? But I'm just going to rinse and repeat as many times as I can. But now we have to understand what's going on. Just like in the banking play, right? Remember, by the way, you're the owner. The insurance company is providing the money. Your money never leaves this account. It's in a tax shelter, growing tax-free, and it's growing guaranteed. It cannot go backwards. It grows every day. Okay. Now this is my ledger. And for anybody that's an accounting major, I know my assets are on the wrong side because I want you to think differently. Okay. So 1, all of these assets, as the government debases our monetary system or our money, and in the form of inflation, my assets are going up in value. So I have a rate of return there. I have cash flow. So I have rate of cash flow here. I have also in here, I have a tax invisible rate of return. Okay, once it's in there, it's never taxed again, right? Okay, I also, because I'm going to graduate from this world someday, I'm 58. I like to say I'm halfway, Todd. I'm going to leave a legacy rate of return, which, by the way, is also tax-free. Now, normally, Todd, you have to decide, hey, I want this account or I want this asset. Here, because I can collateralize my asset and use somebody else's money, it's an and asset. Okay, it's not an or asset. Are there other advantages? Absolutely. One, if I'm using this for real estate, this interest that I'm paying the insurance company could be deductible. Why do I say could be? Because I'm not licensed to give you tax or legal advice. So you have to check with your tax professional. But if your tax professional tells you that in this scenario, it's not deductible, let us know and we'll get you a new one. The other thing is all this money is tax-free. So these assets I'm buying, they're tax advantaged, right? I've got depreciation, cost segregation, whatever I'm doing, right? Now, how many times in your life can you say that the money that you're paying, this interest, you get to deduct off your income, and the money that you're earning, you don't have to pay tax on? Not very many. All right, so most of the marketers on YouTube and social media, they want to focus on this insurance policy. So I taught life insurance for the College of Financial Planning for 10, 15 years. So let me explain life insurance to you in a way that will help you understand the cash side of life insurance. And honestly, when I get done with this, you're going to know more about life insurance and cash value than 99% of life insurance agents out there from a cash value standpoint. Okay, so let's imagine that this is the spectrum of efficiency for cash value. Okay. Cash value efficiency. That's it. No death benefit, not which company does this or which company does that, just cash value. Okay, least efficient. That's easy. Term insurance. Because term insurance, I put in $1, I have $0, but I have a ton of death benefit. Okay, now I'm not saying term insurance is bad. This is just from a cash value standpoint. I could put $1 million in there and I still have no cash value. The only way I win is I got to die. That's a tough way to win, right? Now, when I buy term insurance, am I betting with the insurance company or against them? Against them. They don't think I'm going to die. I think I might. And they have actuarial science on their side. It's not a guess, it's a science, right? Okay, if that's the least efficient from a cash value standpoint, what's the most efficient? Okay, well, that would be a one-pay policy. It's easy. I put in $1 and I have $1 of cash value. Okay, so if I put in $1 and I have $1 of cash value, what's my cost? $0. Over here, my cost is everything I put in it in the term policy. Now, just remember that, because there are people out there that tell you to put a term rider on your policy and you're increasing the cost. Okay. So I put in $1, I have $1, and I have a little bit more than $1 of death benefit. Now, what do I mean by a little bit more? It could be $2, $3, depends on your age, underwriting class, etc. Okay, well, that's pretty cool. I can just dump in $1 million, have $1 million. Now it's in a tax shelter. No big deal. It sounds good, right? What happens when things sound really good in this country? The government steps in. So in 1988, the government stepped in and said, that's not life insurance. There's nothing at risk. So they drew this line on the spectrum of cash value efficiency. And they called it the modified endowment contract line, or MEC. And what MEC says, this line, it says anything too efficient, too much like this, acts like a qualified plan. All the rules, penalties, taxation, of a qualified plan, like an IRA or 401k, et cetera. Now, I'm not talking about, I know you can have self-directed, it's still you have the rules, okay? Anything this side of that neckline is life insurance. Been around since the 1600s in England, since the 1700s in the United States, before federal income tax, plays by different rules. Okay, so we definitely want to be on the right side of that line. Now, universal life, variable universal life, whole life, they're all somewhere in the middle of this efficiency. And we could argue, and people would argue, which one's where. But I want to talk about a whole life policy because it has so many guarantees. And guess what it also has? Some companies offer a rider. It's called a paid up additions rider. Now, there are different names, but in general terms, that's what it is. In a paid up additions rider, it's a one pay policy. Oops. So I put in $1, I have $1, and I have a little bit more than $1 of death benefit. And by combining this paid up additions rider and this whole life policy, I can get its efficiency to slide over right next to this line without crossing it. Okay, so this would be a maximum efficient infinite banking policy. Now, if I don't use the term rider, and I'm going to come back to this in a minute, and I'm going to show you why you don't want to do that, I can get around 40% in here and 60% in the paid up additions rider. Now, this is exactly how Nelson Nash wrote about it in his book, Becoming Your Own Banker, which is the Bible of IBC, so to speak. Okay, I'm not comparing it to the Bible. And it makes it simple. And the one thing that we know is it doesn't really matter. The policy is just the money pool, because I'm going to show you putting this money in motion here in a minute. But let's look at this for just a second, okay? All right. We're going to put $100,000 a year in our policy. This is just an example of the policy, not infinite banking yet, just the policy. Okay, we're still on that. To really explain how we design the policy to be the maximum effective policy for infinite banking. And the reason I use $100,000 is it makes the percentages easy to see. And we have people that are putting a lot more than $100,000 a year, and we have people that are putting millions of dollars a year in their infinite banking policies. And then we have people that are started with less than 100,000, but it's just an easy way to say, okay, 60% of 100,000, that's easy. 40% of 100,000, that's easy. The 40% goes into the whole life policy. The 60% goes into the paid up additions rider. Okay, so I'm going to go 1, 2, 3, 4, 5 years, and then I'm going to jump to 10 and just show you something. Okay. Now, remember, over here, we're putting $100,000 in the beginning of capitalization. So on this side of the house, I put in 60K. I have 60. In fact, I could do this. I could draw this out until my hand got tired, but I'm going to stop in year 4. Okay. Now, remember, this is dollar for dollar. This is just like your checking account. There's no cost, but there's no leverage either. Okay, on this side, I put in 40. In the first year, I might have 2. And that's where the financial entertainers, Dave Ramsey and Susie Orman, say, see, whole life is so expensive. Okay, that means I put in 100,000 and I have 62 to use. Now, remember, we're starting a banking business that has tax advantages, has all of these cool features that we get to control the money. I don't know about you, but the owner of a business always makes an investment. We're going to own it. The customer doesn't have to make an investment. They get the benefits up front. But who makes more money in the long run? The owner. Okay. Now, the cool thing is the way we design the policy is the next year I put in 40 and I might have around 35. The next year it's kind of flat for some. There's a reason for this, but it's a little numbers anomaly in the actuarial calculation, right? So that means, by the way, in these 2 years, I put in 100 and I've got 95. That's pretty good because remember, I have all this death benefit over here, which we're not focusing on, but there's a cost for that. If I just went out and bought term insurance, I know there is. In this year, I'm going to put in 40 and I might have just a little bit more than 40, say 41. Okay, so that means that I'm even, right? It's just like my checking account. I put in 100, I've got 100 or 101, somewhere really close to that. Okay, but now we've paid for our business. Now our business is going to start to leverage. What I mean by that, we're going to put in 40. We're going to have like 45. Okay, once I can do this, I put in $1 and I have more than $1 to use. I don't want to put any of these flat dollars in there anymore. Now, by year 10, I put in 40 and I'm going to have around 60. Now, think about that for a second. You write me a check for 40,000. I turn around and write you one for 60. Are you okay with that? How many times today do you want to do that? So you want multiple policies. The other thing is, if that's the ratio, you get 150% of whatever you deposit. Do you want that check to be big or small? Hopefully you said as big as I'll let you write it, right? Because if I make it 4 million and you have 6 million to use, guess what? You win. All right, let's go back to these YouTube marketers. That's what I like to call them. Because I know they haven't done this for 10 years or they wouldn't design it like that. They say, no, Jim, that's not the way to do this. Is what you have to do is you've got to put a big term rider on here. Remember, that's cost. And because the MEC line is tied to death benefit, that's going to increase my death benefit, right? Which will move the MEC line over here. And it'll make it more efficient. But to do that, I can only put 10% in here because that's all I want. That's a cost. I don't want that whole life policy. They don't want that leverage is what they would say. They wouldn't say that, but that's what's happening. And they want 90% to go into the flat account or the paid up additions account. Why? Because there's no cost and it's easy for them to show their clients, hey, you put in $1 and you have 85 cents or 80 cents and instead of 62 cents or 60 cents. And in the first year, they're right. They're ahead the first year. But if you do it the way that I'm advocating, you're gonna catch them very quickly. You're gonna blow past them, and they're never gonna see you again. Now, in a race, which we're all in a race, that's what you want. You want to finish first, not start first, right? Okay, ready to put all of this into infinite banking? So just know that this is an example. I'm going to put 100 grand in and I'm going to have 60,000 available. All right. So what I'm going to do with this 60,000, I'm going to round these numbers, all of these numbers in this example to make the math easy. I'm going to take this 60 grand and I'm going to make it a 20% down payment. And I'm going to I'm going to get 80% LTV from the seller or the bank or whoever, right? And I'm going to buy
and just for clarity, LTV is loan to value.
Yeah, I'm sorry. Loan to value. Yes. And I'm going to go buy a $300,000 property. Okay. I said it earlier, I think, but when I invest in real estate, I want to get at least a 25% cash on cash return. Now, some of you that are new to real estate might say that's a little high. People that are really have a half $1 billion of real estate or more, they're going to tell me it's too low. I could run this at 20%, whatever, but I'm just going to do 25%. You can adjust, but I'm telling you, it doesn't make that much difference. Okay. So 25% cash on cash return, or making the math easy. I went to public school, Todd. So $15,000, right? $15,000 that flows back to me. So I have 15K sitting in my bank. The next year, and I'm only going to do this for 4 years, I'm going to show you the impact of this. The next year I put in 100,000. I said I would have around 95,000. but I can use the 15 again, right? So I get to use the 15 again because I don't need that for my lunch money. And I have $110,000 to go use. Again, I like easy math. So I'm going to leave 10K in there. And I'm going to take 100,000. I'm going to make it a 20% down payment, get 80% loan to value from somebody else, and I'm going to buy a $500,000 property. I'm going to, on my 100,000, I'm going to get 25% cash on cash, or $25,000 flowing back to me, like wealthy people do it. Money flows to me. But guess what? This money still comes in every single year, that $15,000. So I don't have $25,000 coming back to me. I have 40 because I get this and this. So I have $40,000 flowing back to me. Now, remember what my base premium was? It was $40,000. So now I'm not going to put any more of my money in this. My tenants are going to pay for that. Okay, let's do it 2 more years. Next year, I put in 100,000. Now, this might be a little high, but I'm going to say I have 100,000. Okay, but remember, I got 10 grand up here that I didn't use. Okay, just remember that. And I can use this 40 again. So I have 100K that I'm putting in. I have a 40K that was coming in from my assets. I have 140K, $140,000 to make a 20% down payment, 80% loan to value from somebody, the seller, the bank, whoever, and I'm going to buy a $700,000 property. I'm going to get 25% cash on cash return, or $35,000 flowing back to me. But I get the 35 in this year, plus the 25, plus the 15. That's $75,000. Okay, let's do it one more time. I put in 100,000. And let's say that I'm going to have 105, right? Again, it's probably going to be around 100, but remember I had this money. I only used a little bit of that for this scenario. So I have 105,000 plus the 75. That's 180 grand as a 20% down payment, 80% LTV, loan to value from somebody else. And I'm going to go buy a $900,000 property. I'm going to get 25% cash on cash on my investment, or $45,000 flowing back to me, plus the 35, plus the 25, plus the 15. That's $120,000 a year flowing back to me. Now, my policy won't hold that. Plus, I'm in the 4th year. So what happened in the 5th year in my example? I dropped the premium down to just the base premium. So I'm only going to be putting $40,000 a year in here. So what am I going to do with the money? Well, I could pay down debt. I could start another policy to expand my bank. But in 4 years, I put in $400,000. I bought $2.4 million of real estate, and I've generated $120,000 of passive revenue. Now, why not passive income like people talk about? Because I'm not paying tax on all of this. I'm buying real estate, right? So it's not it's not income, it's revenue. I did that in 4 years. What do you think it's going to look like in 10 years, 20 years? This is the power of infinite banking. This is the power of leveraging and buying real estate and rinse and repeat and building an empire. So Todd, maybe I could stop there and you can ask questions.
Yeah, that was super beneficial. So I have a handful of things that I want to touch on. And Harper, if you want to take it off screen share too. But there's a number of things I want to touch on, because you did a really good job of showing the compounding effect of it. And just to put out there for everybody, like, this is how I technically started our like very early portfolio. And just to give you an idea of how eerily close your numbers were. So I started with a similar, our first policy was a similar number to the example that you used of the 100K a year, right? And we're going to go into like, hey, what should you be putting in? Like that's per person, that's per situation, it's case by case. That's why it's important to be talking to somebody that knows what they're doing. And number one is ethical. Like you have to be dealing with somebody who's ethical. That's why I wanted to introduce you guys to Jim and Harper, because I honestly trust them to build my policies. Like there's a reason that I deal with them specifically. Jim, you learned directly under and alongside Nelson Nash, who wrote the book on infinite banking, Becoming Your Own Banker. He's literally the author of it. So one of the things I wanted to point out was just how close and accurate your numbers were. Okay. So in the first 4 years of building our original portfolio, your numbers were almost exact, specific to like what my monthly income was on rent, right around that $150,000 a year mark, from funding it with the portfolio and getting roughly 25, 30% cash on cash, sometimes a little higher. So one example I just want to give, this is one very, very recent. So we purchased a single family home we're in Northeast, we're in Midwest, we're in Northeast Ohio. So you can buy houses for 50 grand, 100 grand and up. Like you can buy all kinds of different ranges depending on what you want. So we bought a property for $60,000, which would be what? $12,000 down. So $12,000 out of the portfolio, collateralized loan, which I want to touch on because your money stays in the policy. That's really important. So it continues to grow, but you still have access to it. So a collateralized loan from the insurance company, that's the down payment, right? Now the rest came from a bank at the time that we bought it, was like 4%, 5% or something like that. So we owned it for 14 months, rented it for $850 a month, between $850 and $900. It was month to month for a couple of months, so it went up a little bit. So between $850 and $900 a month. So if you want to do the math on that, that's roughly $10,000 a year in rent. And I put in 12 grand. So my cash on cash is nearly 100% year one. Okay. We just sold that property because we're going to reinvest. We bought it for 60. We had 12 in it out of our own cash. We sold it for 120. So our cash on cash at that point, so we made $72,000 on 12 grand in 1 year, in 14 months. And I didn't have to come up with new capital to do that. So all of that 72 can do what? It can go back in, and it has the ability to be recycled and put back out into another asset that's larger. So this house was 60 grand. It can go into the next house, and the next property could be 200 grand or 400 grand or 500 grand or whatever it is. And we've done that from literally houses that cost 10 grand. If you're saying like, I can't do that in my market, you can invest in any market. So don't use that excuse, just understand. You can do this for a $10,000 property all the way up to millions of dollars. Like I've literally done it on $1 million property before, multiple $1 million properties. So it's very, very beneficial. So I'm glad you showed the compounding effect of that over time, because I was watching you go through the numbers and I was like, that's eerily similar. It's like I'm looking at our own sheet, like from the first 4 years of doing it, like just specifically from that account, which is really cool. Not even talking about the tax benefits. You hedge against inflation. You have appreciation. If the market goes up, you get to ride all of these waves. You get to hedge against all these things. So when people are worried about inflation, hey, what do I do to fight inflation? You buy tangible assets and then you never worry about it again. Because if windows go up, guess what you own more of? You own more windows. If storage unit doors go up, what do you own more of? You own more garage doors. Like, so you get to ride the wave and you don't have to use any extra work or extra bit of your time to be able to ride that wave. So I'm glad you pointed that out. So I wanted to point that out just first and foremost before I even got into questions, because if you're watching this right now and you're thinking like, well, that doesn't seem that easy. No one's saying it's easy and that you won't have management and you won't have hurdles and you won't have challenges. Like, welcome to life, welcome to business. But that's absolutely a doable and possible scenario that he just ran through, because it was almost like you were looking at my sheet and you had no idea of my numbers, like in that portfolio before this. Like we didn't talk about it. So I just thought that was cool. Some other things I want to talk about.
No,
go ahead.
No, you know what? No, that's really cool because, Todd, I get people that say, and just like you said, hey, that number's too low. But there's always the new person that thinks the number's high because they just haven't gotten the experience yet. So I appreciate you saying that because, and I tell people, look, this is just an example. This is what I would think I would expect to get. And so I'm glad you validate that. That's very cool. Thank you.
Yeah, and the thing too is like the first time you do it, maybe you're not that good at it. You'll get better at it over time. So you'll be able to capitalize on different opportunities because you have different assets and you have different experience and wisdom. So I'm a big believer in that. So I thought that was great. So one of thing I wrote down a handful of things that like as you were speaking, these are common questions and common things that people bring up that I think it's best that we probably cover here. So number one is your money doesn't actually leave the policy. It's a collateralized loan. So do you want to touch on that for a second, like what that actually looks like? Because a lot of people think, well, my retirement, I can take from my retirement. No, it kills the compounding of your retirement. That's why, I mean, you said my trigger word. You did say 401k in that presentation. So
Yeah.
it's very,
No.
it's a very dangerous thing to bring up in front of me. So like the, the point I want to make in that is, if you want to touch on this, is if you pull from a retirement account, the whole point of the retirement account and being penalized to touch it is because it needs to compound. Now you can have that compounding effect and touch it.
Yeah. So, Todd, what we're talking about here is interrupted compounding versus uninterrupted compounding. So let me give you an example, and this is a little bit hard without a visual. So your audience is going to have to trust my numbers. But let's say you had a penny and you could double that penny every single day. Okay. Without interrupting your compounding. Okay. But let's say on day 21, you've got to go buy a car. Now, in that account, you're going to have about $40,000, right? And that's what it's going to take to buy the car. You're going to trade in your other car. I'm sorry, it's about 20 some $1,000s. You're going to borrow 20 some $1,000 plus your car, and you're going to go buy a car. Okay, so on day 22, that's on day 21. On day 22, what happens to your compounding? It starts over. Yeah, it starts over.
You have 2 cents again, or you have 1 penny again. You start everything over again. It's so frustrating. Yes, like I watch people start back at 0 every month.
Yeah. Yes. And so if you didn't interrupt it, right? You took a loan against that account and you didn't interrupt it, at day 31, you have $10,700,000. Now, I know, Darren Hardy talks about this in his book, Compound Effect. There's lots of different books that talk about this, but uninterrupted compounding is a powerful force. Okay, so we have to realize something, and we have to accept that there's a problem that we all have as humans in this country. We finance every single thing that we buy. We either give someone else interest, we pay them interest, and we buy things, or we give up interest that we could have earned. Okay. If you took that $60,000 property, or the down payment for the $60,000 property, and you went on a cruise, well, it's not just the money that you spent on the cruise, it's what that money could have become, which is the $120,000 property plus the cash flow, plus the tax savings, plus. It's very expensive to consume our money because there's lost opportunity cost. So the whole thing about this collateralized loan is it allows our money to compound uninterrupted, not just like the penny, but the same principle. I wish we could do what the penny did. But so Todd, that's one thing. But you touched on 401ks, right? So let me just ask you 3 general questions, just real quick. First question, are taxes going up or down?
Up.
Up. Absolutely. It's just math. Medicare, Medicaid, Social Security, and the debt, the national debt taxes have to go up. Second question, Are the dollars in your pocket, are they worth more today or in the future?
100% today, because inflation's a real thing.
That's right. Now, you and Harper are young guys, but when I was a kid, you could buy 5 candy bars for $1. Okay. And now you can't buy 1. So the dollars in my pocket are always worth more today than in the future. Last question. This is a farming question, so this might be difficult. Would you rather pay tax on the seed or on the harvest?
Always the seed.
The seed.
That is
little amount.
Oh man, it drives me nuts. Yes, but small. Okay. Yes.
Now, you know this, and is 401ks and all of their brothers and sisters and cousins qualified plans, they violate all of the answers that you just gave. You're taking good dollars, you're putting it in away in prison for 20, 30, 40 years to get back bad dollars at a higher tax rate. And guess what? The government won't tell you what that tax rate is. Would you ever invest in real estate if you didn't understand the tax consequences?
Not a single time. Yeah, literally never. And you lose all control. People are going to argue, well, you can decide what to put in it. You lose control. You can't touch it for 40 years. You can commit a federal crime. You can commit a major crime and get out of prison before your money does.
You know, what's funny, Todd, is when people say you get to choose what it goes into, it goes into a system where you have no control, where you're literally gambling on something that no one can predict.
You are going to
lose.
We're going to spend the next 40 minutes on this. We're careful. You said Harper's like, you touched Todd's his favorite topic right there.
Well, one thing I will say, and this might play into a future question, is the money stays within the insurance contract, within the policy. But when you borrow, something that's vitally important is the insurance company, you actually are the one in control of that line of credit. So like if you have a line of credit against home equity, like in your house, or you're pledging a brokerage account or something else as a line of credit or a CD at a bank, the third party is the one who's really in control. But with the insurance company, an insurance contract, you're the one in control, and you get to control how you go about paying back the interest and principal. And you have tons of flexibility on how to go about it. And since they're not trying to go mark this money up and go profit like a bank would, a bank's going to have a cost of money, and then they're going to mark it up, and then they're going to make a difference in profit, right? Well, the insurance company is not going to doing that at the same rate. So right now you could borrow around 4 or 5% from these policies, where the market rate of interest for a third party for a line of credit may be closer to 8% or 8.25%. So you get a couple benefits because you're the owner in this picture, right?
So that is a great point. So that actually brings me to a question I had further on, but we'll just touch on it now. And the question is, this is a question that I get: do I have to pay it back?
Right. Well, the answer is no, you don't have to pay it back. If you don't pay it back, or we're going to assume that you're going to use this money, or your family's going to use this money, because you're going to be using money till the day you die, right? Mm-hmm. But if you're not spending a lot of money, and you don't know really what to do with all this money sitting in these insurance contracts, guess what? Your kids, your grandkids, your great grandkids, you can loan money to them and have them pay you back and with interest. And when they do that, they increase the death benefit. But let's say that you had $5 million for one policy, had $5 million of death benefit, but you had a $3 million loan on it. That means when you die, the loan is paid back from the death benefit, right? And somebody might say, well, don't I get the cash value and the death benefit? Well, you had a loan against it, right? So It's like a mortgage. You don't get the house and all the money that you paid into the mortgage when you die. But here's the other cool thing is, in the scenario that I used when you were going to borrow me the $100 million, and again, we can talk about that after the recording.
I was going to say, is that still open for discussion?
That is still open for discussion. Is I'm going to take your $100 million. I'm going to be generating, like you said, at least $25 million cash on cash. At those numbers, I think I could do better, by the way, but at least 25 million. So I don't care if I ever pay you back. I'm going to pay you 5 million every single year, and I'm going to keep at least 20. I'll do that forever.
Yep.
So you don't have to pay back the loan.
Yeah. So one of the things, and this kind of rolls into my next point, is, well, how do you make an expense cheaper? Because if you don't have to pay it back, because to Harper's point, you own it, so you can have some flexibility in how you design this. Like at a certain point, once you're funded that 1-to-1, in year 4 in your example there, once you're at that level, once you're able to borrow more than you've put in, let's say you have a $100,000 tax bill or a $50,000 tax bill. If you have that, get more real estate. But let's just say, as an example, you have that. Let's just say, just for easy math, you're 2-to-1. So every dollar you put in, you can borrow $2 against it from your own policy. you can now pay $100,000 tax bill with 50 grand.
Exactly.
Like all of your expenses become less. You're able to recapture your expenses. So if you're a business owner and you have payroll, you'd be able to run your payroll through it if you wanted to. So if your payroll is $50,000 a month, but you're 2-to-1 in your policy, you can now pay your $50,000 payroll with 25 grand.
Yeah.
Or how about this? Go ahead, Harper.
Yeah, I was gonna say one thing that a lot of people have been doing recently, is since we work with a lot of business owners and real estate investors, is they have escrow funds like property taxes and insurance bills. And the bank literally escrows that most of the time. And you got to ask, why are they willing to do that? Is it out of convenience? Well, maybe a little bit, but they could go loan that money out, right, before they pay that bill. So why don't you do that yourself? Or maybe you have it in a debt account and you know you can't go invest it because you got to have it liquid. Well, why not send that to your policy, let it sit there and earn interest, or pay back some outstanding loans against the policy to not have as much of a interest on the policy loan, right? So you're creating more wealth, but it's simply flowing your money a different way.
That's next level understanding of a wealth cycle. Like if I put money out, how can it come back to me? If I can ask myself the question and run my decision making through a filter of, does this money come back to me? And every time it says yes, I do it. And every time it says no, I don't. Like you're going to start building wealth really, really quickly that way.
And how fast does it come back to you? And how fast can you redeploy it? Because then you create velocity of money, Todd. And you know what? Here's the great thing about all of this. Guess who gets to decide how you use all of this money? Guess and you get to decide. You're in control. Now, the cool thing in the scenario with you guys is you're coaching your community on how to go build real estate, right? Perfect. We coach them on how to use your monetary system to support that. And so you get two coaches on, and it's amazing because you're getting specialized coaches. Tiger Woods might have a swing coach and a putting coach, but you need both, right? Scotty Scheffler showed that in the Open over the weekend. No, I'm just kidding. He putted really bad.
So another piece to this too. Okay, if I can make an expense cheaper, if I can have money come back to me and I don't necessarily have to pay the policy back, which you should because you want to feed your own bank, especially early on. But that being said, the question becomes, well, wait, how can I make a liability earn something? Because it's actually possible. So let's say, let's use a car example because everybody loves cars here, right? All right. So Harper, in your roles, Jim, you've had a whole mess of things. I'm a Ferrari guy. Like, let's say I want to get a Ferrari, right? Ferrari fanboy for anybody out there. Okay, let's say I'm gonna get a Ferrari. If my policy is kicking off more profit and interest, right, when I borrow from it, than it takes me to borrow from a normal bank and put it into the car is actually paying me to drive it.
That's
I'm
right.
I'm actually making money to enjoy the thing that I want to do. And now when I sell it, I put the money back in my policy. Like it just becomes a wealth transfer play, but it actually creates for me while driving it. Most people don't understand that and see that. They go, well, wait a second, if I borrow from it, it's going to cost me interest. No, it's not. You're paying yourself back. You're not paying somebody else. The payment no longer goes to Discover or Amex or whatever bank that you've borrowed from. You borrowed from yourself. So whatever you want to enjoy can now become free over time.
So once in that scenario too, Todd, now think about this is, and you know this as a Ferrari fan, but a lot of the audience probably doesn't, is just your everyday person can't walk into a Ferrari dealer and buy a brand new Ferrari, right? You actually have to earn the right to buy a Ferrari, a new one, right? But once you have that and you can order 2 models ahead or 4 years from now, I promise you, and I just did this on the Series 1 Hummer, the electric Hummer, is I ordered it. Before I ordered it, before I took delivery, I had already made $70,000 on that car, right? And it cost me $128,000, or no, I'm sorry, $115,000. Now think about that though, Todd. I already know that I can sell it for a $70,000 profit. All I did was borrow the money from my insurance company contract. I used the insurance company's money for a few days. Let's say it was 2 weeks. So I paid the interest on 115 grand, which is peanuts at 5%, and I made $70,000.
Exactly.
Now, once I made that, where did I put the 70 grand?
It goes right back in.
Back in the insurance contract. Then I loaned it out again. And so the thing is that what's fun about this is it's the same thing with real estate. Yes, you don't understand how it all works. That's why you have a coach, right? That's why you go find somebody that knows how to do it, do what they did, learn from them. But once you get it down, you and I use our systems differently, but I could learn from you watching you do your system, your infinite banking system, your real estate system, and you could learn from me. Well, if I learn something from you that makes my business bigger and better, more creative, then it just leverages over and over and over again.
Yeah, it just becomes faster. That was the last thing I had written down. Harper, anything you want to close with? And then down below in the descriptions, you're going to be able to find their contact information. That way, if you have questions, you're able to reach out and they'll be able to take the next steps from you. But Harper, anything you want to close with?
Only thing I would say to add what we're just talking about is when you are repaying yourself, like if you're repaying a loan on a car or some other assets potentially, it could be a little tough to go access that equity again. But if you're paying yourself back, you can actually go reborrow that, within a couple of days if you needed to. But as it stacks up, you don't have to go do this big elaborate refinance. You could just say, hey, I want another loan. And when they send you the funds again, you can recycle it.
They have to give it to you. Harper, like what's the application process?
You say, hey, send me my money. And then within a couple of days, they
literally. Yeah. I mean, I think the last time I did it was a couple of weeks ago. And I mean, I literally know the form number off the top of my head. I'm like, I'm gonna fill this out. I literally just send the email and they send me a confirmation that they received it. And then I just keep an eye on my account. That's it.
It's beautiful.
Yep. So first of all, thank you guys for taking the time to hang out, provide this for people, because I think it is really, really important. I was going to bring up earlier, like the battle between IUL and whole life, like that's like the never ending comparison and battle. But I think you explained it really well, why we like specifically whole life and why we use that. I think that was a great explanation. So thank you for doing that. Thank you for taking the time to educate everybody. It means a lot to me. Obviously, my mission is to end financial suffering. So if you guys have questions, I think the best thing that you can do is reach out with the information down below and figure out and take some time and learn if this is for you, right? Figure out, put a plan together. How can you best maximize your finances by using this method? If you believe that this method is for you. If you don't believe it's for you, it's totally okay. But we're big believers in it. That's why we wanted to share it. I've been practicing it for years. These are the boys that built it for me. So I wanted to be able to share that with you guys, which means a lot. If you found this informative and helpful, please leave a like down below. You can subscribe to the channel. We're going to be talking about infinite banking more and how you can use it in your life and create a wealth cycle with it. I also teach this within our wealth cycles course. So in the description down below, you'll have an opportunity to join that. You can join the community and you can interact with us directly. So if you have any interest in that, make sure to check that out down below. We hope to see you in the community.